Welcome back to Investing Talk Podcast, the show where we cut through the noise and distill complex information into insights you can actually use. Today, we're venturing into, well, let's call it the Wild West of investing, quantum computing. We're tackling a question I know many of you are asking about, a really fascinating company. Is D-Wave Quantum a good time to buy right now? We've got our hands on a pretty comprehensive investment analysis. It breaks down D-Wave Quantum from, every angle, fundamentals, valuation, the technical charts, future outlook. Our mission today, unpack all of this, pull out the really important bits so you can get a shortcut to understanding this this revolutionary but, pretty complex company.
Absolutely. And what's really critical here, I think, is moving beyond just the hype. You hear so much about quantum. This deep dive lets us look at the core data, the numbers, and ask those tough questions, like how do we even evaluate this kind of cutting-edge tech in the market today? It's really about balancing that huge promise with the current reality.
Good point. Okay, before we really dive in, if you're finding these deep dives valuable, please take a second to subscribe, maybe like this, leave us a comment. It genuinely helps us bring more of these analyses your way. And hey, if you're feeling extra generous, you can even consider buying us a coffee. Your support really does help us keep these explorations going. Setting the stage. What is D-Wave Quantum? All right, let's unpack this. Before we even glance at the numbers, who is D-Wave Quantum? Why are they making such waves in this quantum computing space? What makes them, stand out?
Well, D-Wave Quantum is definitely a pioneer, no doubt about that. They've been around for a while in quantum terms. What makes them unique, really, is their approach. They build both annealing quantum computers and gate model quantum computers.
Okay, annealing and gate model. Can you break that down a bit? What's the difference?
Sure. Think of annealing. It's really excellent for solving specific, very complex optimization problems, like finding the best solution out of millions of possibilities. Gate model, on the other hand, is more like a general-purpose quantum computer. It's designed to tackle a much broader range of tasks, the kind of things people often think about with future quantum breakthroughs. So having both, this dual approach, it gives them a pretty unique position in the market. They can address some immediate commercial needs with annealing,
Right.
while also working towards those, future, more generalized quantum solutions with gate model.
That dual capability does sound key. So what kind of actual real-world problems are they trying to solve with this, incredibly advanced tech?
Yeah, they're targeting truly challenging problems, the kind that classical computers really struggle with. Think about massive logistical puzzles, like optimizing delivery routes on a global scale, or advancing artificial intelligence, developing new algorithms, even things like innovating in material science, discovering new materials with specific properties, or accelerating drug discovery and sophisticated financial modeling. And what's pretty significant, especially for a field this new, is that they already have a customer base. It includes major global enterprises.
Wow, okay. So real companies are paying for this already.
Exactly. It shows that real-world utility is starting to emerge. It's not just, theoretical potential locked away in a lab. The fundamentals, a look under the hood.
Okay, let's shift gears. When we talk investing, the first place many of us look is, well, the fundamentals, the basics. So what do the numbers tell us about D-Wave Quantum's financial health right now? Are they pulling in serious revenue?
Well, serious might be relative here. The source material we looked at highlights their trailing 12-month revenue, or TTM, came in at $21.36 million.
$21 million.
Okay, now hold that number. Compare it to their market cap, which is hovering around $5.2 billion.
Billion. With a B. Okay, whoa.
Yeah.
So that modest revenue, $21 million against such a hefty market cap, it basically shouts one thing loud and clear. The stock's current price is purely, almost entirely, a bet on future potential, not on existing fundamentals.
Right. It's a wager on what they might become years down the road rather than what they are today financially.
Precisely.
And, given that massive market cap against such relatively small revenue, it feels like we're probably looking at a tech company still burning through cash.
Oh, definitely still deep in the investment phase. Profitability, not yet. Not even close, based on these numbers. The company is currently unprofitable. Their TTM net income was negative $131.99 million.
Oof. Negative $132 million. Yep. And negative earnings per share, or EPS, of negative $0.59. Their cash flow trends are also decidedly negative, which, reflects those ongoing heavy investments they have to make in research and development, building out the tech, trying to grow.
Makes sense for the field, I guess, but
But it raises a critical question, right? For a cutting-edge tech company like this in such a capital-intensive field, how long can this level of cash burn continue without some clear path to profitability becoming visible? That's the risk.
That is a crucial point. If they're burning through cash, are analysts even managing to give us future earnings projections for D-Wave Quantum? Or is it just, like, too early, too uncertain for that kind of foresight?
Yeah, not really. Not in a reliable consensus format that's widely available or highlighted in the analysis we saw. The lack of detailed earnings projections, it basically indicates significant uncertainty. Or, more likely, it just confirms they are still very much in an early stage of commercialization. Traditional earnings forecasting just isn't mature or reliable for them yet. It's still very much a frontier investment in that sense.
Is the price right?
Okay, now let's turn to, arguably, the most interesting part for potential investors, the valuation.
Yeah.
With those fundamentals we just discussed, modest revenue, negative earnings, what do the traditional valuation ratios tell us? Is the price anywhere near right?
Well, right off the bat, given the negative earnings, you can't calculate a price earnings or PV ratio. It just doesn't exist.
Right, no earnings.
But their price sales ratio, the PS ratio, it is extremely high. We're talking approximately 240 times.
Wait, say that again, 240?
240. 2400 times. That's derived pretty simply from their $5.2 billion market cap divided by the $21.36 million in TTM revenue.
240 times sales, that number is just, wow, it's eye-popping. What does that actually mean for an average person looking at the stock? How should they interpret that?
Yeah, it's astronomical to put 240 times sales in perspective. Well, it's like paying the price of a luxury mansion for a small plot of land where someone promises to build one eventually. It absolutely blows past typical tech industry averages, even for really high-growth companies. It just underscores that the stock is valued at an extraordinary premium compared to, well, almost anything. Most technology peers, even other quantum computing companies, which are also often highly valued.
So it's pure expectation.
Exactly. This isn't about current sales performance at all. It reflects incredibly high growth expectations baked in for the future. It's essentially, like you said, a moonshot wager, where today's financial numbers are almost irrelevant to the current price. And it also means standard valuation methods like discounted cash flow or DCF. Forget about it. It's impractical here. You just don't have the positive, predictable cash flow or reliable earnings projections you need to even attempt it.
Why?
Technical trends. The roller coaster ride.
Okay, so the fundamentals are weak, the valuation is through the roof. But what about the market itself? What about the stock chart? Has D-Wave's stock price actually been as, well, volatile as that valuation might suggest? I can imagine with this kind of cutting-edge technology, it might be a bit of a roller coaster ride for investors.
A roller coaster's putting it mildly. Far, far from a smooth ride. The recent price action has been highly volatile. The source material notes an absolutely massive 52-week range. Get this, from $0.75.
75 cents.
Yep, 75 cents at the low end, all the way up to $19.77 at the high.
Wow.
And if you look at the one-year performance, an astonishing price increase of 1,360%.
1,300% in a year. Okay.
Yeah. The stock currently trades around $17 as of this analysis. So, I mean, if you're an early investor who got in near those lows, you'd be absolutely ecstatic right now.
Sure would.
But jumping in now around $17 after that kind of run, that's a very different proposition, obviously.
So a huge upward trend, clearly, but it's obviously come with a lot of massive swings and dramatic movements. How do the technical indicators reflect that kind of volatility? Are they screaming buy or run?
Well, it's mixed, as you'd expect with such a move. While the recent trend is clearly upward, it comes with that high volatility and really large intraday ranges, meaning the price can swing wildly within just a single trading day. Short-term moving averages, they might look bullish. They reflect that strong recent upward momentum naturally.
Okay.
But other indicators, things like the Relative Strength Index, the RSI, or the MACD, they are likely, almost certainly, in overbought territory given such a vertical, near-parabolic move. And overbought conditions often signal, a potential for a pullback or a correction. Doesn't mean it has to happen, but the risk is elevated.
Right. The elastic band is stretched pretty tight.
Exactly. And the stock's beta, which measures its volatility relative to the overall market, it's 1.39.
So higher than the market average of 1.
Significantly higher. It indicates it's considerably more volatile than the market itself. So when the market moves, this stock tends to move even more dramatically, both up and down. V sentiment and catalysts.
Yeah.
What's driving it?
Okay, so we have this picture. Weak fundamentals, sky-high valuation, huge volatility, but also incredible recent gains. what does all this mean for the general sentiment around D-Wave quantum? Are analysts bullish? Or are they seeing some of these same red flags we've been talking about?
It's interesting. Analyst consensus, according to the source, is actually strong buy.
Strong buy. Okay, that sounds pretty positive.
It does on the surface. However, what's truly fascinating here and a bit confusing is that the average price target provided by those same analysts is $15.14.
15, 14. But you said it's trading around $17 now.
Exactly. The average target is below the current trading price.
Wait a minute. A strong buy recommendation, but the average target price is actually lower than where the stock is currently trading. That sounds, well, contradictory. How do we make sense of that? Are they saying buy it but expect it to go down first?
It's a great question, isn't it? And it really highlights the paradox here. It suggests that analysts probably believe strongly in the long-term story, D-Wave's potential, their leadership in annealing, the whole quantum future. But they might simultaneously be signaling some caution about the immediate price level. Perhaps the current valuation has simply outrun their models, or they expect some volatility around earnings, or just a natural pullback after such a run.
So long-term believers, but maybe nervous short-term.
That could be one interpretation, yes. What seems to be fueling the overall positive sentiment, despite this nuance with the price target, is D-Wave Quantum's continued progress. They keep launching new products like their Advantage 2 system, they're expanding their Leap Cloud service, which gives access to their quantum computers, and they are, importantly, growing that enterprise customer base we mentioned.
Right, tangible progress.
Yes, these are tangible signs of progress and adoption. And sentiment among tech-focused investors generally is pretty positive. It aligns with the broader excitement around quantum computing as a potentially transformative technology.
Okay, that makes sense. Are there any specific upcoming events or catalysts, things investors should watch out for that could significantly impact the stock? Either, in the near future or maybe further down the line.
Absolutely. In the short term, their next earnings release is pegged for August 7, 2025, according to the source.
Okay, earnings coming up, always a volatile time. Especially given the current lack of profitability and high valuation, yes, that could definitely bring increased volatility. Also, continued product rollouts, any news on performance improvements, and announcements of new enterprise partnerships, those are also immediate short-term catalysts to watch. For the longer term, the big picture stuff, it's really about the broader commercialization of quantum applications across major industries. When does this technology truly go mainstream and start solving billion-dollar problems routinely? And specifically for D-Wave, their planned integration of both annealing and gate model quantum solutions into some kind of unified platform, that could be a huge driver of future growth if they pull it off successfully. That's the big long-term vision they're pitching. 6. The risks. What could go wrong?
Makes sense. Now, every investment has its risks, right? And with a stock like this, basically riding on future potential and hopes and dreams, it feels especially important to understand those downsides. What are the key risk factors for D-Wave Quantum that investors absolutely need to be aware of before jumping in? Yeah, crucial question. And there are several layers of risk here. First, on the stock-specific side, we've got the ongoing negative cash flow and earnings we talked about. The company isn't expected to be profitable anytime soon, which means they'll likely continue to rely on external funding, maybe issuing more stock, which could dilute existing shareholders.
Okay, profitability risk. What else?
Second, that extremely high valuation. Yeah. It's based purely on future potential, which carries a significant risk of a sharp correction if those lofty expectations aren't met, or if there are delays in quantum technology adoption, or if a competitor makes a surprise breakthrough.
Valuation risk. Got it.
And third, just the mechanics of the stock itself. The high trading volumes combined with those sharp price swings mean a substantial liquidity risk and volatility risk, especially for short-term traders. You could see your investment value fluctuate wildly and potentially face difficulty selling at your desired price during rapid drops.
So, negative financials, sky-high price based on hope, and a wild ride day to day. Those are pretty significant company-specific concerns. What about broader risks, things beyond D-Wave itself that could impact them?
Good point. Looking at the bigger picture, the entire quantum computing sector is still very nascent, very speculative. It's basically a technological arms race with many competing technologies and approaches out there, superconducting qubits, trapped ions, photonics, annealing like D-Wave focuses on. It's not yet clear which approach will ultimately dominate, or if multiple approaches will coexist, or even if the market will develop as rapidly as some enthusiasts hope. So there's a big sector-specific risk there. You could back the wrong course, technologically speaking.
Right, the whole field is a bet.
Exactly. And then, of course, you always have broader macroeconomic risks. Things like a general tech sector downturn, rising interest rates making speculative funding harder to get, or overall market corrections. These could disproportionately affect high-growth, high-risk stocks like D-Wave, as investors tend to flee speculative assets first when uncertainty rises. Final rating and recommendations.
Okay, so we've covered a lot of ground. From their pioneering tech, the annealing and gate model stuff, to the pretty stark financial realities, the crazy valuation, the roller coaster stock chart, and all those risks. After diving deep into all these aspects, what's the overall rating from this analysis? What's the bottom line? But what should our listener really take away from this about D-Wave Quantum?
So the analysis wraps it all up and gives D-Wave Quantum a final rating of 6 out of 10.
6 out of 10. Okay, not terrible, but definitely not a ringing endorsement either.
Precisely. A 6 out of 10 isn't really a buy or a sell recommendation in the traditional sense. It's more like a flashing yellow light. Proceed with extreme caution. The rationale is pretty clear.
Huh.
The strong growth potential, their leadership position, particularly in annealing, it certainly justifies interest in the company. They are a legitimate player in a potentially revolutionary field. However, the current extremely high valuation, the high volatility of the stock, and the negative fundamentals, no profits, burning cash collectively suggest considerable significant risk.
So who is the stock actually for then?
It seems best suited for investors with a very, very high risk tolerance. Or perhaps those who can genuinely afford to allocate a small portion of their portfolio to a highly speculative bet and hold it for the very long term, like 5, 10 years or more. You're essentially betting on quantum computing's ultimate commercial success and D-Wave's ability to capture a significant piece of that, and you need to be comfortable with the possibility of losing a large chunk or even all of your investment along the way.
That 6 out of 10 really crystallizes it, yeah. High potential, high risk. What about specific entry points? The analysis mentioned the stock is around $17. Is there a better price for different types of investors, maybe short-term versus long-term players?
Yeah, the analysis did offer some thoughts on that, though obviously timing the market is incredibly difficult, especially with a stock like this. For short-term traders, given the volatility, if a pullback does occur, maybe looking for entry in the $14 to $16 range might be considered. The idea being that the current price near $70 is close to recent highs and quite susceptible to volatility, especially around that upcoming earnings report.
Yeah.
But it's a very tactical, risky play.
Okay, so maybe wait for a dip for a short-term trade. What about long-term investors?
For long-term investors, the suggestion was quite different. It was more about accumulating shares in stages, maybe dollar cost averaging, if the stock corrects significantly. Specifically, the analysis mentioned considering accumulation below $10 per share.
Below $10? That's quite a drop from $17.
It is, but the thinking is that getting in at that lower level would create a much more favorable long-term risk-reward profile. It makes the investment less dependent on the current speculative hype and more grounded in a potentially more reasonable valuation, assuming the long-term story remains intact.
So, boiling it down, is this something you try to flip quickly, or is it a multi-year hold, lock it away kind of stock?
Well, for the short term, as we said, the high volatility and the pending earnings could offer swing trading opportunities for those who are skilled and, frankly, lucky. But you have to be acutely aware that the risk of sharp, sudden corrections is significant. This is absolutely not for the faint of heart. For the long term, yes, the company's pioneering status and its commercial focus do provide a potential foundation for future growth. But, and it's a big but, it's only suitable for investors who can truly tolerate that uncertainty and stomach the volatility over an extended period. We're talking years, potentially many years, not months. Just to give an idea of the short-term focus in the source, it even suggested a potential stop loss for very short-term traders at $15 to protect against immediate downside, and maybe a take-profit target near $19.50, aiming for those recent highs. That tight range itself speaks volumes about the expected price swings and the risks involved. Outro.
Wow. Okay. D-Wave Quantum really is a classic high-risk, high-reward play, isn't it? A pure bet on the future of quantum computing. The current valuation seems highly speculative, based mostly on hope, and it certainly seems better suited for those with a very long-term horizon and, frankly, a very strong stomach for volatility. It's definitely not a set-it-and-forget-it kind of investment.
Absolutely not. And, you know, this whole analysis, it raises a really important, broader question for all of us as investors, I think. Given this blend we see here, truly cutting-edge, potentially world-changing technology mixed with intense financial speculation, what broader implications does D-Wave Quantum's journey and others like it have for how we value any kind of major innovation that's still just on the cusp of mass adoption? How do investors, how do we truly balance the immense promise of a future technology with the often stark reality of current financials, negative cash flow, and the deep uncertainty surrounding commercialization timelines?
That's a fantastic question. How do you price a revolution before it happens?
Exactly. It's a dilemma that faces many pioneering tech companies. And D-Wave is really a prime example playing out right now.
Definitely something to chew on. Well, thank you for joining us on this deep dive into D-Wave Quantum. We really hope this analysis helps you navigate the exciting but undoubtedly complex world of investing, especially in these groundbreaking technology areas. Until next time, keep learning, keep questioning, and keep exploring.